Hello everyone, welcome to Blue Dragon Actual. Now today we are going to discuss profit reporting. The unfortunate or fortunate part about this is we have already recorded this. Like I have recorded this chapter for one day, and after recording it for 44 minutes, I found that there is no somehow the microphone was not working. Hopefully today is not the case, and today we'll be able to finally upload this. However, the fortunate part is that by that logic or by because of that thing, I'll get to read it one more time along with all of you. So that will kind of clarify my concept in profit reporting even more. So I don't think that as a bad thing. It's just that it was not able to like I was not able to kind of upload it on that day. However, I did upload a bonus video on that, which was 1 crore package, and also there was a question on that, which was kind of common question for few people who don't likely like who would like to blame the world. So for that, I have also posted an answer. You can check that in my video. Also, the IFOA results are out. So unfortunately, I was not able to clear SA2. I got 58. 60 is the passing marks. I failed by 2 marks, and 57. Sorry, I got 57. 60 in the passing marks. I failed by 3 marks. I was kind of checking the mark breakup. I didn't know that IFOA is kind of giving mark breakup because last time I don't remember when I wrote the paper from IFOA last. This is the in April I kind of decided to write the paper from IFOA, but it's okay. So I'll post a separate video on the analysis, maybe in 2 or 3 parts, because there are 3 questions. I might post the video in 3 parts, like what probably went wrong and what I could do. And I think all these are part and parcel of actually. And no matter like although the sad part is, yeah, obviously I'm not able to clear this paper for last 2 years, but the good part is that because of this I am very thorough with the concept of SA2 both from India perspective and from UK perspective. And I hope that is also evident in these videos that I'm making. That thoroughness is what gave me the confidence to kind of open the YouTube channel along with the practical work of course. So I think that this is not a bad thing, and I'll also come up with a video about why I think that sometimes knowledgeable people are not passing the paper, yet people who are not that knowledgeable are passing the paper. So if you like kind of want to make me a video on that, just put it in the comment or like the video. Anyways, starting, let's start. So profit reporting. Now profit reporting is this is one chapter that is kind of related to the accounts part, or more related to accounting rather than rather than the actual part. However, as an actuary, you need to understand this, and this is also one chapter that will give you a bigger picture of the how the insurance industry, life insurance basically works, and how everything is kind of falling into place. Everything that you do, probably if you are working, how everything is kind of falling into place. So that picture you'll get here, and that will make you a better actuary. So normally in IFRS 4, we are kind of based on prudent reporting. So the difference between prudent reporting and maybe a best estimate reporting is that prudent reporting is only the regulator is kind of interested in the prudent reporting, because regulator is interested in the protection of the policyholder. So regulator wants to know if you have sufficient money so that you can pay your liability. However, the shareholder is interested in the profit, and that's why they are kind of interested in the best estimate assumption. Like without, if you take out the prudence, what is the profit that you can make? So that's why traditionally, at least in India, there are two types of reporting, which is one is called shareholder reporting and one is called statutory reporting. Right, statutory reporting is kind of sent to IRDA, and shareholder reporting, which comprises of the VNB and the embedded value. We'll cover embedded value in maybe in the next week. So that would be shareholder reporting. That would give a picture to the shareholder about the profit they can generate because they have kind of invested in this business. So usually the formula that goes in IFRS 4 is your premium and investment income. So this would be added. These are positive cash flows. Then benefits, expenses, and increase in reserves. So these are negative cash flows. That would give you the gross profit. The sum of this premium and investment income minus your expenses, benefits, commissions, increase in reserve will give you the gross profit. That's the overall formula. However, this I mean, this is how we kind of calculate the gross profit. But in IFRS 17 or best estimate, this thing does not work. it has completely changed, and we'll get a flavor of IFRS 17 here, although it is not covered in that much detail. However, the most important part that we have to understand for before starting this chapter is, for life insurance, the profit is recognized over a period of time, because the service is given over a period of time. So if a contract is of 10 years duration, you will get some portion of the profit initially, because your way it is priced, the life insurance product is priced. If you remember the equation of value, it is present value of premium, which is at time zero. Equation of value is obviously at time zero. So present value of premium would be equal to present value of benefit plus expense plus present value of profit. Right now, present value of, if you kind of change this equation and alter this equation, if you keep the present value of profit here, and if you take the present value of benefit and expense to the other side and take a negative of that, so that would be minus of present value of profit plus present value of expense minus present value of premium is equal to your present value of profit. So if you see the equation with that minus sign, it is actually the equation of reserve, which means that your profit is kind of residing in your reserve, right? So that's why when the margins get released, you get profit, right? So that is the basic concept, and that's why, because of this present value thing, your profit, a portion of the profit which is kind of imbibed in the premium, when the first premium you receive, a portion of the profit is crystallized, but the remaining portion would not be crystallized, because assuming this is a regular premium product where premium would be paid in several times. So remaining profit would depend on the experience, right? And depending on the experience, the remaining profit will be realized. So life insurance is the only sector where a profit will be realized over a period of time. So that's why initially you will see a lot of capital strain, but as you proceed in the business, if provided the experience turns favorable, you will see profit. Unlike a different business, say a chocolate company, in which you produce a chocolate for 10 rupees and you sell it at 20 rupees immediately at the point of sell, that is immediately at time zero, you recognize 10 rupees profit. But in life insurance contract, that is not the case. You only require, like, suppose if you are over the period of the contract, suppose if you are kind of supposed to get around 20 rupees profit, you will get only 2 rupees in the first, when the first premium would be paid, and remaining 20 rupees will depend whether, and that 20 is also expected. So the remaining 20, whether you will get the 20 will depend on how the experience is. If the experience is as per your best estimate, then you will exactly get 20 rupees. If it is less than your best estimate, then you will get less than 20 rupees. If it is better than your best estimate, then you probably end up getting 50 rupees, right? Who knows? But that is the problem, or that is the challenge with life insurance. That's why the balance sheet, the income statement of life insurance cannot be compared with any other uh, any other company. That was the case initially, but right now IFRS 17, other the regulations that comes into picture, they are trying to kind of bridge that gap. Also, as I mentioned, there are two types of reporting: statutory reporting and the shareholder reporting. So different regulations have tried to keep it only one reporting, so that there will be less pressure on the resource, right? And both the shareholder and the regulator can use the same statement, and there will be no controversy like why this number is not matching with that number. There is no bridging. So because of that, only one reporting is kind of suggested, and that will be the future as well. So I think this portion that I have kind of discussed right now, before just going into the chapter, is very important. And if you have not understood this portion, you need to rewind and listen to this portion, up to this portion again. And after that only come to the chapter, because I'll keep referring to this portion, and this portion is very important for this entire chapter, right? So the introduction is, as I mentioned, there are two types of reporting. So one is regulator and one is shareholder. Also, it is important for the creditors, employees, tax inspector, general public, even for the credit rating agencies. These are important. But we know the basic fundamentals why regulators are kind of interested in the prudence, shareholder is interested in the profit, right? So that's exactly same thing is kind of written here. Now, statutory reporting, obviously the purpose of the statutory reporting is to kind of to see that the policyholder liabilities are kind of met, and insurer has sufficient money to kind of pay the policyholder liabilities, right? So that's what is being kind of discussed here. Now in reporting, because I mentioned that this is kind of related to the accounts part. So because of that, there are two types of main accounting body which are kind of setting those standards or guidelines. One is IASB, which is International Accounting Standards Board, which is much closer to UK, and the other is Financial Accounting Standard Board, right, which is much closer to US. So they create the GAAP, FASB. They created the GAAP. If you have worked on US product, you have probably heard about GAAP. There are so many regulation AG 43 and so many other. AG 43 is probably related to annuity. There are so many regulations that GAAP has kind of produced, and ISB, IFRS 4, IFRS 17, those are kind of created by ISB. In fact, before the creation of IFRS 17, both these accounting bodies were kind of came together and they were trying to develop IFRS 17. But after 20 years of work, I think FASB decided to, they had a difference in opinion and decided to move out. And they created their own standard, which is kind of equivalent to IFRS 17 called LDTI. Maybe a few people would be working on LDTI at this point in India. Personally, I have not worked on LDTI, but I have heard that it is very close to IFRS 17. Obviously, the entire world is moving into IFRS 17, maybe at different dates, but at least most of the 80% of the countries would be moving into IFRS 17 from 1st Jan 2023, which is just around the corner, right? And I think for India, it would be maybe 2026. Regulators delayed the implementation because India is not that close to the proper implementation. The infrastructure is not in place. So yeah, it depends. But those anything with IFRS would be released by International Accounting Standard. Anything with financial accounting standard would be kind of released by anything was related to GAAP, and US specific thing would be released by FASB. So that is the distinction that we need to have. So rule based versus principle based. Rule based means it will give you exactly what you need to do, right? So how would you treat the expense? How do you treat the income? How to treat the asset, whether asset and liability can offset each other. Principle based is discretionary. It is left up to you with how you can probably offset asset and liability. You may not offset asset and liability. It is up to you. You have to kind of disclose what logic you are using, right? So that is basically the kind of the point of discussion here. So there is a question like give possible example of areas where discretion, as I mentioned, discretion is kind of related to the principle based, right? In the production and presentation of statutory accounts, and could make it difficult for the user to compare across the companies. So obviously one of the main reason you are producing financial statement is for the investors, so that they can compare and they can get the result and understand where to invest, right? So that is why comparison is a very important aspect. So example would be different approaches taken to allow risk. Example, the rate used in discount rate, the disclosure of sensitivity analysis, smoothing of profit, etc. So everywhere there is also in case of charges, there is some discretion. Unit link product, there if there is a discretion. So everywhere there is some discretion in kind of calculating the product, in kind of calculation. Then the principle based accounting might come into picture. You remember the discount rate I mentioned in market consistent. Everyone says that it is valued by like the risk period is used, but why risk period is used? Because they don't want discretion there, right? Otherwise, you will use your own risk period, someone else will use their own risk period. So because in order to cut down that that discretionary feature, so that you can compare like to like, apple to apple, we use the risk period. There is market consistent valuation does not mean it has to be discounted by risk period. It's just an assumption, because otherwise everyone else would be using different discount rate. So that's where it was kind of made rule based, right? So going concern versus wind up, obviously reporting can be of two types. Going concern, it means your company is going to survive, and wind up. So in that case, seniority of the claims becomes important. Like debt holders had more seniority over the equity holders, and equity holders is also kind of are subordinate to the preferential shareholders, or debt holders are superior to the subordinate debt holders. So all this depends, and your solvency would be a concern for a wind up basis, and the accounting will entirely change. As I mentioned, seniority takes precedence when there is wind up basis is consideration. So profit recognition, commonly profit is recognized in the period in which it is accrued. Now accrued means it is not earned, right? It is not earned. It is accrued. Now, as I mentioned, that in life insurance, profit is realized over a period of time. So when this principle, this profit recognition principle of when it is being accrued is very complicated for life insurance product, because ideally when you have sell the product, you can say that my profit has accrued because I have sold the product, but that policy can lapse. There might be surrender, right? There might be so many other things. So you cannot just say that, okay, my expected profit is, say, as I gave the example, 20 rupees, and I will recognize 20 rupees now. right? Because this concept is applicable for others in other business, like you have sell a product and you will get the payment over time or something like that. That there you can say it is accrued, but in life insurance depends on the experience. So that is why it is very difficult or very troublesome for life insurance. And wherever there is some discretion, as for example smoothing, like smoothing of earnings from one period to the next, it is even more difficult, right? Because there is some management discretion, is even more difficult, and it can be even more misleading. So this is something that IFRS 17 kind of try to capture using the concept of CSM, which we'll see later in the chapter. So in this case, in this case, what is actually meant is the principle that is the principle is the profit is kind of recognized when it is accrued, but not when it is earned, right? So that is the main concept, that is the main takeaway. Consolidation, obviously we need to consider whether, suppose if there is internal reinsurance, then overall you are kind of reinsuring your subsidiary, right? So in the consolidated balance sheet there should not be any transfer of risk, right? Something would be positive in your subsidiary and something would be negative in your own financial statement, and when you take care of the consolidation and take care of the consolidated balance sheet, it would come out to be zero, right? It will offset each other. And here also it is important what you can offset. So present, whether you are presenting liabilities net of reinsurance, right? Presenting value of policyholder obligation net of future premium. Now this is a concept which is more used in 1 year product. We have seen in ALSM regulation something called unearned reserve, like that is the concept that is being called out here. Also, if you have studied ST1 or SP1, you have kind of seen the concept. Netting the values of derivative construct, obviously derivative in insurance sector, you can like there is a regulation that you can only use it for hedging. You have seen the derivative rate, derivative circular. So you can only, for Indian scenario, you can only use it for decline in the interest rate for without profit policies. And that's why it has to be kind of netted with the underlying. So if you have purchased into interest rate derivative and you are making profit in that, it has to be kind of captured along with the losses that you are making in the whether losses you are making in the indoor asset side, so that you are hedging it basically. So because you are hedging it, you are hedging it with respect to something, right? And that's why it has to be netted out. So that's the consolidation principle. Adding a net value of the subsidiary, obviously, rather than presenting the asset of the liabilities. So this is the internal reinsurance example that I gave. Calculation complexity, obviously, it should be simple enough so that everyone can understand, but it should also give you enough information so that complexity would be there. Reporting basis. So reporting basis can be it is dependent on the, as I mentioned, the purpose. It can be best estimate or it can be prudent, and you already know when it can be best estimate, shareholder reporting best estimate, prudent for the regulator, right? Consistency with other financial reports. One of the main reason that insurer like we are moving into IFRS 17 is that if it can be compared with balance sheet of other companies, say for example a chocolate company, right? So then an investor can probably see where he or she should invest, right? So that's why there should be a comparison between life insurance company or that two life insurance company belonging to the same country, between two life insurance company maybe belonging to different countries, right? And then maybe a life insurance company and a different company, like the example I gave, like a chocolate company belonging to a different industry. So that way the consistency should be there. The basic premise here is that shareholders should be able to understand or compare, right? Explain why statutory reporting standards typically report consistency across companies of many industries. The statutory accounts are used by potential investors, right? In investment making decisions. Same premise, and that's why an investor has hundreds of companies to invest in. If they cannot compare, they would not be able to understand which represent the best opportunity for them. And that's why you require that consistency. So moving on, international financial reporting standard. Most of the things we have covered. One thing is IFRS 9. So IFRS 9 is also kind of in motion, set in motion with IFRS 17, and IFRS 9 would be kind of applicable for most of the insurers after they have kind of incorporated IFRS 17. IFRS 9 is for related to the asset side. So asset would be kind of valued as per IFRS 9. In India, we have the regulation which we have already covered, which is preparation of financial statements and auditors report. So here you can see how these regulations are kind of coming into one place, right? As I mentioned at the start of the chapter, that everything you have studied till now, if you have followed my channel, you've understood my channel, you've taken notes, so you would be understanding that everything is kind of boiling down to this point, right? The ALSM regulation was one of the boiling point. This chapter is one of the boiling point. Derivative circular is coming into picture here. IFRS 9 would be kind of used to value derivatives, to value your asset. In the preparation of financial statement, everything was kind of valued at the historical cost, other than the equities, which are listed equities. Other than that, everything was kind of valued in historical cost. If you remember that, otherwise you can check that video. So obviously, like we have kind of seen the principle, but IFRS 9 have certain principles which are fair representation, that it should represent the liabilities perfectly or fairly. Then there would be a going concern. Obviously, we have kind of seen that actual based. We know that is a challenge for the company. Comparability, obviously, compliance. It should comply with all the IFRS 17 or all the IFRS requirements, and there should be a written disclosure about that. The reporting period, obviously, there has to be a reporting period like 1 year. After every year, you are going to kind of prepare, and it should be prepared in a manner that it can be compared with the previous period. So if there is sufficient change from the previous period, then there should be a reason for that change, right? You cannot just change an accounting practice just like that, based on your whims and fancies. Understandability, obviously, it has to be written in some manner. It is understandable. And offsetting, as to whether asset and liabilities can be offset, whether income and expense can be offset. So all those are required to be understood. Okay, so moving on, fair representation. It should represent the fair. It should give a fair position for the financial position and performance. Going concern, we already know accrual basis. We have already seen comparability, compliance, reporting period has to be at least annually, right? We have already seen understandability. It should be readily understandable. Offsetting, asset and liabilities, income expense may generally not be offset, right? May generally not be. You have to kind of show it clearly. One of the example that I remember is in Indian scenario, your investment yield is kind of reduced to allow for the investment expense. But here they say that you cannot do that, right? So they say that your investment income should be separate, your investment expense should be separate. They should not offset each other. Anyways, moving on, accounting for insurance contract for IFRS 4. This is where the story of IFRS 17 comes into picture, because it was kind of created on I think May 17 or March 17. It came to be known as IFRS 17. Initially, it was thought that by 2021, 1st Jan, it would be applicable for everyone, but then, I mean, it was impossible, right? So that's why it was changed to 1st Jan 2023. Now, obviously, for IFRS 4, there is a definition for insurance contract. What it means is there should be a significant insurance risk, right? In order for a contract to be insured, there should be a significant insurance risk. Now, what this significant insurance risk means, that the financial risk that is there, that should be lower as compared to the insurance risk. So what that means is we'll see in the regulation or part linked policies and non-linked policies, that the premium, the sum assured should be 10 times the premium or 7 times the premium, right? So that means that your whatever you are paying, the insurance risk that is there is significant enough, right? So that's the catch. Like, the insurance risk has to be significant, then only it will be classified as an insurance contract. Otherwise, it is an investment contract. Then it should be valued under IFRS 9, not under IFRS 4, right? So that's the thing. So, for example, IFRS 4 does not define which is significant. What do you mean by significant? It is left to, like that principle-based thing, it is left to your discretion, right? In practice, if the benefits payable on insured even exceed 105% of the benefit, that would otherwise be paid. What would mean by otherwise be paid? It means, if suppose your government is paying something, right? You have a medical, like in US, there is a health policy. If the government covers everyone, right? So if the government is paying you, say, $100, and the insurance policy should pay you $105, right? So that's what it means, that it should be higher than any benefit that is otherwise paid. Or it would also mean, suppose if you have put the money in bank saving account, it will give you, say, 4% interest per annum. But if you are dying, you will get around 1 lakh, or maybe more than that, 20 lakh, right? So you are getting way more. because there is that would mean that there is a significant insurance risk, right? And here it shows what is financial risk. So anything that is without the insurance risk would be a financial risk, which would be interest rate risk, security, foreign exchange. If you remember the GN22 to any the external cash flows, like it was embedded derivative was something which was kind of changing the insurance policies cash flows with respect to some financial variables. These are those financial variables, right? Interest rate, foreign exchange, index of price, credit rating, trading index, etc. Reinsurance IFRS 4 stipulates that the need to disclosure insurance liabilities gross of insurance, gross of reinsurance, and to test the reinsurance asset for impairment. So what it does mean is that you need to this approach is actually similar to the reinsurance treatment and Solvency II. Reinsurance asset is the value of the expected reinsurance recoveries, and the impairment in reduction in the value of the and then the value included in the accounts to reflect the possibility. So IFRS 4 specifies the condition for the impairment of there being objective and evidence. So this means that you should disclose your gross liability rather than your net liability, right? So that should come in your financial. Reinsurance should be allowed for by in the P&L statement is kind of allowed for by reinsurance recovery and reinsurance premium. Reinsurance premium is a negative thing for the insurer. Reinsurance recovery is a positive thing. That's how insurance is kind of allowed for, and obviously the reinsurance asset would be subject to some kind of revaluation or impairment, right? So that's how reinsurance is valued, but your liability you would not show the net liability. You show the gross liability. So IFRS 4 stipulates some exemption from IFRS 9 for embedded derivatives. So obviously IFRS 9 is used for assets, and that would value the embedded derivatives. We have already covered that. Financial IFRS 9 is standard cover accounting for financial strength, right? Moving on to IFRS 9, sorry, IFRS 17. So IFRS 17 has three basic approach, which is the building block approach, also known as general measurement approach, which is the basis of IFRS 17. Then there is variable fee approach. If there is something linked, like if there is a linked policy, unit linked policy, a clearly defined pool of assets, something the policy cash flows are varying with a pool of asset, something which is linked to some outside financial variable, then it would be called variable, right? And fee is something that you are kind of paying to the insurer. As for example, in a participating product, you are paying 10% to the shareholder, right? In a non-participating and in a unit linked product, you are paying charges to the policyholder. So that's what is called a variable fee approach. Now here I will answer the previous question that is kind of left, which is what is non-negative residual addition. So for a unit linked product, there is a cap on charges, right? So for example, in 4 years, you can only charge 4% per annum per year on a per year basis, obviously per 4% per annum on that basis. So maybe in 1 year you can charge say 6%, but in other year you have to charge maybe 2%, so that your average comes out to be 4%, right? So there is a cap like that. So what is done is, you along with your unit link policies, you also have a shadow fund where you kind of capture whatever is going on in the unit link policies, but then that would be kind of rolled over in actual rate. And if in some cases you are seeing that you have deducted more charges than that is supposed to because of the cap on charges, right, then you need to kind of add further units to your unit fund. That is called non-negative residual addition, because then that would always be non-negative, because there is a cap on charges. You have kind of defined that cap on charges in previous year. This year you are kind of doing that so that you are kind of reverting back those charges by giving some addition. So that is called non-negative residual addition. That was a question that I've asked in my previous to previous video, right? So that's the overall concept. Okay, premium allocation approach. Premium allocation approach is a very simplified approach. It is usually used for contracts with short duration, like 1 year group product. But it is not that it cannot be used for contracts with longer duration. It can be, but it is very close to IFRS 4. However, for life insurance, it is usually used for 1 year contract, and that's why like group business kind of contract. And because of that, we'll mainly focus on BBA. Now, BBA has 4 parts, which is first is the fulfillment cash flow. Fulfillment cash flow is the entire reserve, the prudent reserve. That is the fulfillment cash flow. Then the prudent reserve in IFRS 4, right? That is the prudent fulfillment cash flow. Time value of money is basically what it means, the best estimate liability. And risk adjustment is the prudence part, is the margin part, which you have already studied maths and pads. So BEL plus risk adjustment is equal to your FCF, or the fulfillment cash flow, right? And then there is one thing called contractual service margin, which is the unearned future profit, the profit that you have not yet earned. So if you remember our equation of value, present value of premium is equal to present value of benefit plus present value of expense plus present value of profit. And I mentioned that if you kind of roll over this equation from left hand side to right hand side, it would be minus of reserve equal to profit, right? So in this case, you can write minus of FCF is equal to CSM, or FCF. So that means that your CSM at time zero is equal to minus of FCF, right? And CSM can never be negative because it's a profit. It represents profit, right? So profit cannot be negative. If it is negative, it represents loss, right? So profit cannot be negative. But not for reinsurance. So there is a separate concept of reinsurance CSM, which we are not going to cover here. That is a concept for IFRS 17. That reinsurance CSM can be negative, but the CSM for a direct business can never be negative. The reason is that if it is negative, it is loss component, and because of the prudence concept, see, loss would be recognized on the same time. However, CSM would be recognized over a period of time because profit is generated over a period of time, right? That is the thing that we've discussed at the start. That's why that start portion is so important. So profit is recognized over a period of time. So CSM would be recognized over a period of time through something we call coverage unit. Like every year you are providing this much service, that service would be measured by coverage unit, and you would only recognize profit up to the level of service you have provided. Next year, you are providing some more service, you will be recognizing that profit. Moving on. So that is why contractual service margin at time zero is equal to minus FCF. And as you move on, it will depend on the coverage service, how it can be recognized. Right? The method of calculating BEL is similar to that that we have kind of calculated in Solvency II. Both are based on best estimate, right? Now, when you are calculating reserve on best estimate basis, so if it is a profitable contract, if it is written on profitable basis, what would mean that the expected present value of benefit and expense would be less than expected present value of premium, right? So premium is the value that you are getting from the policyholder, benefit and expense are the value that you are giving away. So if it is written on profitable term, it should be like that. So that would mean that if it is calculated on best estimate basis, your reserve would be negative, right? And if your reserve would be negative, that would mean that at time zero, your FCF would be negative, and minus of negative reserve would be positive, right? So that's why CSM would be positive. And if that is not positive, if that is negative, it means that it is written in loss making terms, right? And there is very few reason for a company to write a contract in loss making term. Maybe it is new, it is trying to capture business, that's why it is writing the contract in loss making term. So in that case, there would be no CSM would be zero, but we'll write something else which we'll call loss component, and loss component is recognized on that period only. Suppose in a particular year you recognized that there is a loss component of 100 rupees, that will flow through your P&L, that will reduce your profit by 100 rupees. However, if in a particular year we will see that there is a CSM of 100 rupees, that CSM would be recognized over a period of time, and that is because of the prudence principle. And because we are prudent, we are kind of following that approach, and also because the profit in the life insurance would be kind of recognized in that manner. Right, so risk adjustment basically means the margin. It can be calculated in the following method, which is the value at risk method, which is you are 99.95% confident that in next 1 year there will be only this much loss, right? So you are keeping that amount. Conditional tail expectation, this would mean require a stochastic calculation, and you will only take the tail, because tail are the region where I mean there is the problem, right? And you will say that in that 99.95% of the time it will not fall in the tail. So we have covered it for 99.95%, and if in the tail, if it falls in the tail, then it's a one-off event, right? And there is also a cost of capital approach, which we have kind of already studied in when we have studied about the capital, the economic capital, right? That is the cost of capital, of the stress capital, non-stress capital. You can do that same calculation method, and if you don't remember it, you can check my capital management video, right? There we have clearly discussed this. So this is the risk. So I can tell you how my company does it. It calculates the reserve on prudent basis, is calculates the reserve on best estimate basis. Prudent minus best estimate would be the margin, that is risk adjustment. So we follow that simple approach. So different company can follow that different approach, right? Contractual service margin, we have already gone through this equation, right? Explain why CSM would be expected to be profitable for a regular premium contract, despite initial expense being likely to exceed the initial premium. We have already, if it is written on a profitable term, it is supposed to be profitable. So that's it. Otherwise, there is no point, right? Why would a company write loss-making business? So that's it. We have covered all of this, and then VFA. So VFA, we have also covered the loss-making part. It is recognized at that point of time, loss component. VFA is similar to VBA. It's the only exception. It varies with respect to some external cash flows, right? For example, unit link product, you can invest in several funds. So unit link product can be VFA. Par product can be VFA because these are savings product, right? So mostly a saving product would probably fall under the VFA, but obviously there are several manipulations, several judgment that applies there as well. Mostly par product and unit link product will be VFA. So accounting for investment contract, as I mentioned, investment contract should be kind of earlier it was measured in accordance with IAS 18, and now it would be measured with replaced by IFRS 9, right? And it is effective from 1st Jan, but if it is kind of like entities can only accept or incorporate IFRS 9 when they have incorporated IFRS 17. So accounting for financial instruments, once again, this has to be done by IFRS 9, as per IFRS 9. And we have already gone through the financial instruments accounting in the preparation of financial statement auditor report regulation. Mostly same approach applies here. The biggest stress is on fair value. There it was on historical value. Here, because of the market consistent principle, we are kind of applying the fair value, and it is available easily for asset. And the financial asset at initial recognition can be classified into one of the following, which is fair value to profit and loss, available for sale, right? Available for sale. If you sell it, you will get the price. Held for maturity, that is for the annuity kind of product, or bond which are long term. The loans and receivable, obviously you know the value for that. Fair value to profit and loss, it means when you are trading, right? When you are trading, so that would kind of determine your fair value of the asset. So asset held for trading, right? See this, with the intention of selling in short term would be fair value asset valued at fair value to profit and loss, and available for sale. This is like long term, right? And quoted equities fall under available for sale. This is like investment. This is trading. This is investment, right? And the assets which we are kind of doing the trading, that their fair value would be given by the profit and loss, and asset which are kind of you are holding for sale for a long time. So that their the sale price will determine the value, right? And government bonds, so corporate bonds would fall under this maturity. So these are the categories, right? These are the categories of asset. You will classify the asset in these categories, like we have different types of asset, right? Okay, moving on. So US GAAP is kind of created by FASB. As I mentioned, there are two bodies, right? And the principle would mostly be same: fair representation, going concern, compliance, historical cost. Here, there is a lot of stress on historical cost, right? In for IFRS 17, I think there is a lot of stress on market fair value. Revenue recognition matching. Though this is an interesting concept. We'll see what that concept is. Full disclosure, obviously, that is required. Objectivity, which means judgment, right? Consistency and offsetting. So fair representation we've already gone through. Going concern we already know. Compliance, similar to IFRS, and it has to be the claim with the compliance with US GAAP is must. Historical cost, compliance should value asset and liabilities at acquisition cost rather than at fair value market. So we have seen in preparation of financial statement auditor report video that it is kind of that is it's very important that this is kind of every asset there was kind of valued at historical cost other than equities, right? So they also use the same value. However, I personally believe that fair value is much better. As IFRS 17 is way better. If you are kind of valuing asset on historical cost, you are creating a deviation which should not be there. Revenue recognition, company should record revenue whether it is earned, when it is received, etc. Right? However, losses must be recognized when they become probable. So the same concept of IFRS 17 revenues or the and this profit was kind of recognized over a period, right? But and here it is also when it is earned rather than when it is received, right? Similar to kind of that accrued concept. It is when it is earned, it is considered received. The cash flow has not happened, right? So when it is earned, it is considered received, but losses must be recognized when they are probable. So this is a slightly aggressive approach, and this is slightly prudent approach, right? So in parallel, they are coming to the best estimate basis, because one is prudent, one is approach. Matching is related to the expense, and they what they are saying is expense will be recognized only when there is matching revenue. So as for example, suppose you have purchased a computer, right, and you have not used that computer for 1 year, but you are using the computer from the next year. So the expense should come in your P&L in the next year, because there it is helping you to generate revenue. Before that, it should not come into your balance sheet or P&L. That is the concept of matching. That expense should be matched with revenue whenever it is reasonable to do so. Expense should not be recognized when they're incurred, but when the work undertaken makes it contribution to the revenue. Right? The example of computer that I gave. So there is a question on describe how deferred profit liability could operate. Now this is also a principle which is kind of before embedded value. This was kind of used. So as I mentioned, in life insurance contract, there would be huge cost initially, and then over the period of time, it would be obtained. The profit would be obtained, and that's why it's a capital intensive product. But in order to, because of this, there is a distortion of profit, right? In the first year there will be loss, and in the second year slowly there might be less loss or profit which come into picture. So in order to remove this kind of distraction, what they do is they divide the acquisition expense, because the main cause of loss would be the acquisition expense. In the main cause of expense would be the acquisition expense in the first year. So suppose your acquisition expense is 1,000 rupees and your product duration is 10 years. So you will say that 1,000 divided by 10, 100 would be recognized in every year, right? So what this would do is this would kind of reduce your loss in the first year, or probably make it profitable, and in the next year it will increase your loss, because in the first year earlier you are recognizing 1,000. In this case you are recognizing only 100, but in the next year you are recognizing 0 as acquisition expense, but in this case you are recognizing 100 as acquisition expense. Now obviously you cannot defer your expense. This is called deferring of acquisition expense, right? Coming from the matching concept, that as we are giving the service, we are kind of taking that expense into account, right? So we are not taking every expense into account whenever it is kind of incurred. So that's the one concept. Now what it does is increases the profit in the first year, but reduces the profit in the remaining years, and that's why it's called deferred acquisition expense. But after that, embedded value came into picture, and embedded value was where you are kind of taking care of the future profit, which is the same thing that CSM is doing. So I think that is a better approach as compared to DSA. And there is also a lot of subjectivity involved. You cannot defer your expense beyond your product duration. As for example, the product is 10 years and you are deferring your expenses by 20 years, seeing that this is a expense that is also helping that product. So there is a lot of judgment involved, right? And that's why I think embedded value is much better approach and much more fair approach as compared to deferred acquisition expense. Full disclosure, obviously, what is the importance of making a full disclosure. That's why financial statements are, it's at the end of the day, it is disclosure only. Objectivity, information should be factual and verifiable, right? Information can be verified. Consistency, it should be presented consistently from period to period. As I mentioned, if there is a change in accounting practice, there should be a reason for it. And offsetting asset and liabilities, the income and expense may generally not be offset. We have seen that in IFRS 4 as well. Even the same concept applies, right? The hedging part was also kind of there in the consolidation portion, right? Difference between US GAAP and IFRS, obviously there is the difference of the insurance contract definition in US GAAP would be like linked, non-linked, participating, non-participating, unitized with profit. But in IFRS 4, there would be whether there is a significant insurance risk or not. That is the definition of insurance. The difference lies in the definition itself, right? Compliance, there is some difference whether you have to make explicit and implicit compliance. Revenue recognition, once again, there is some difference between the accrual concept and the earned concept. Matching concept does not exist in IFRS, but it exists in US GAAP, right? And obviously there is some difference in the disclosure part. But mostly you can see that these two principles are kind of based on same thing, like fair representation, the offsetting part, revenue prudence part, right? Some US GAAP is even on historical cost, where IFRS is on kind of market consistent basis approach, and that's the future, market consistent with the future. So Yeah, that's it. I think that's the end of this chapter. I hope you had a good time listening to this. This is the chapter which gave me the big picture when I was kind of studying it, and also helped me to understand various concepts in my daily work. And yeah, thanks for watching. See you in future videos. And if you enjoy the content, please like, share, and subscribe. Please watch the whole video. I understand that today the attention span is very less, but I mean, as I keep on saying, there is no point in clearing papers if you don't have the knowledge, right? So in order to build the knowledge, you have to work hard, and this is part of working hard. You have to see the entire video. You cannot skip as see the video. So yeah, thanks for watching, and see you in future videos.